Tired of the daily grind and wondering if you could live off your investments instead? Curious about turning your investments into a consistent income stream that lets you live life on your own terms? The idea of never having to work again is so relaxing, isn't it? Let's crack the code on how much you need to invest to achieve financial freedom through dividends. In this video, we'll show you the exact amount you need invested to live off dividends. We'll reveal the math behind it, why dividends alone might not be the best strategy, and we'll cover some tax tips to maximize your earnings. In the end, I'll show you a combination of drip and weekly investment strategy with an actual stock portfolio that has the potential to turn your investment into over $2 million and pay around $60,000 in annual dividends. So I often get questions from you guys about living off investments, and one of the most common questions is, how much do I need to invest to cover my monthly expenses with dividends? It's a fantastic question and one that many of us wonder about. For many, a comfortable lifestyle might mean having an additional $3,500 a month or $42,000 a year to cover expenses like housing, food, and leisure. Receiving income like this without 9-to-5 jobs sure sounds like a dream, right? Well, today, we'll break down how to achieve living off dividends, a goal that once felt unattainable to me. With the right strategy and patience, it's possible. I'll share insights and real-life examples to guide you on whether you want to supplement your income or fully retire. This video will equip you with the knowledge to make informed investment decisions and work towards that financial goal. All right, let's get into the nitty-gritty of dividend investing. So first off, what exactly is a dividend? Simply put, a dividend is a portion of a company's earnings paid out to shareholders, typically on a quarterly basis. It's like getting a bonus just for owning a piece of the company. Companies share a part of their profits to reward investors for their trust and loyalty. Dividends can come in the form of cash payments, additional shares of stocks, or other property. Now let's talk numbers. Imagine you own shares of Apple. They pay an annual dividend of $1 per share. The stock price, hovering around $220, gives you a dividend yield of about 0.46%. Not exactly mind-blowing, right? But it's a start. The dividend yield is calculated by dividing the annual dividends per share by the price per share. It's a quick way to see how much bang you're getting for your buck. For Apple, every dollar invested is giving you a half a cent back annually. To put this into perspective, let's see how much you'd need to invest in Apple to reach a target annual dividend income. If your goal is to earn $40,000 per year from dividends with Apple's yield of 0.46%, you would need a substantial amount invested. Here's the calculation. Your required investment will be annual dividend income divided by the dividend yield, which comes to $8,695,652. Yeah, that's right. You'd need around $8.7 million invested in Apple to earn $40,000 annually in dividends. Not many of us have $8.7 million available for investment, and if we did, we might not need the dividend income in the first place. But what about those companies known as dividend aristocrats? These are companies that have not only paid but also increased their dividends for at least 25 consecutive years. Their yields are generally more attractive, ranging from 1 to 4%. These companies are considered reliable for generating consistent dividend income. Examples include Johnson & Johnson, Coca-Cola, and Procter & Gamble, known names. These firms have a history of rewarding their shareholders through thick and thin, making them solid choices for anyone looking to build a dependable stream of passive income. Now let's break down how much you would need to invest to live off dividends from these more reliable sources. And again, let's say your goal is to earn $40,000 a year from dividends. To give you a clearer picture, let's look at required investments at different dividend yields. At a 2% yield, you would need $2 million invested to generate $40,000 annually. With a 3% yield, you would need about $1.33 million. At a 4% yield, you need $1 million invested, and at a 5% yield, you need $800,000. The higher the yield, the less you need to invest, but remember, higher yields often come with higher risks. Companies with very high dividend yields might be in financial trouble or their stock prices could be falling, which is why it's crucial to understand the balance between risk and reward. For example, a company might offer a 7% yield, but if it cuts its dividend in half during tough times, your income takes a significant hit. It's also important to consider the stability of the dividends. Companies with lower but more stable dividend yields can be better long-term investments. For example, utilities and consumer staples often have lower yields but offer greater security, as their services and products are always in demand. On the other hand, sectors like technology and finance might offer higher yields but with more volatility. Even though 5% is considered borderline safe, most of us still don't have $800,000 lying around. So let's get real. Living off dividends sounds amazing, but it's not as easy as it seems. There are several challenges and realities that you need to consider before diving into dividend investing as a primary source of income. So this is a good time to look at some net worth statistics. According to recent data, the median net worth for Americans by age group paints a very sobering picture. Those under 35 have a median net worth of around $39,000. Aged 35 to 44, it's about $135,600. 45 to 54, $247,200. Aged 55 to 64, $364,500. 65 to 74, $409,900. And at 75 and older, the median net worth sits at about $335,600. Even if you're in the 45 to 54 age group with a median net worth of $247,200, it's a far cry from the $1 million needed to generate $40,000 annually at a 4% yield. This gap highlights the reality that most people aren't anywhere close to the level of wealth required to live comfortably off dividends alone. Let's put this into perspective with a more detailed example. Suppose you're 50 years old with a net worth of $247,200, which is the median for your age group. If you invested all of this at a 4% yield, your annual dividend income would be your net worth of $247,200 times the dividend yield of 4%, which equals $9,888. That's only $9,888 per year, or about $824 per month. Clearly, that's not enough to live on for most people. To reach the goal of $40,000 annually, you'd need to significantly increase your investments. For example, you'd need roughly $1 million invested at a 4% yield, which is significantly higher than the median net worth for most age groups. So ultimately, investors often fall into what I call the dividend trap, chasing high yields to meet the target. But even though high-yield stocks can be tempting, they come with their own set of challenges. Companies offering high dividend yields might be doing so because their stock prices have dropped significantly, often due to underlying financial problems. For instance, if a company is struggling financially, it might cut its dividends to conserve cash, which can leave you with less income than you anticipated. Furthermore, during economic downturns, even reliable dividend payers might reduce their payouts. For example, during the COVID-19 pandemic, numerous companies slashed or suspended their dividends. This is why diversification is crucial. Relying solely on a few high-yield stocks can be very risky. Instead, spreading your investments across various sectors and including both high-yield and stable lower-yield stocks can help mitigate this risk. So what's the solution here? Is there no hope? Is it even worth trying to invest? The answer is absolutely. And there is hope, especially if you're young and have time on your side. Remember, in the end, I'll show you a combination of multiple investment strategies with an actual stock portfolio that has the potential to turn your investment into over $2 million and pay around $60,000 in annual dividends. Look, if you're young, like many in the John's Money Adventures community, focusing on growth might be a better strategy than dividends. When you're just starting out, you have time on your side, and that's a powerful ally. The stock market has historically delivered strong returns over long periods, and younger investors can take advantage of this by focusing on growth stocks rather than high dividend yielding stocks. Growth stocks such as Amazon or Google have historically outpaced dividend stocks in returns. These companies reinvest their profits back into the business to further fuel their growth rather than paying them out as dividends. This reinvestment can lead to significant depreciation in the stock price over time. For example, if you had invested in Amazon 10 years ago, the value of your investment would have grown tremendously compared to investing in a high-yield dividend stock. One of the most common concepts in investing is compound interest. In fact, Albert Einstein is often quoted as saying, "Compound interest is the eighth wonder of the world." The magic of compound interest means your money grows exponentially over time. The earlier you start investing, the more time your money has to grow. For instance, if you invest $10,000 at an annual return of 7%, it will grow to $22,433 in 10 years. But if you wait 10 more years, it will grow to $47,037. In 30 years, it'll be $95,436. That's the power of starting early. The power of compound interest can be further amplified when you factor in dividend reinvestment and regular contributions. When you invest in dividend-paying stocks, you receive periodic payments from the company's profits. Instead of taking these dividends as cash, reinvesting them allows you to purchase additional shares of the stock. These new shares will generate their own dividends, which are then reinvested, creating a compounding effect where your dividends begin to earn dividends themselves. Adding to this strategy, making regular contributions to your investment, whether on a monthly or weekly basis, further accelerates your wealth accumulation. Each new contribution buys more shares, which can earn dividends and appreciation in value. As you consistently invest additional funds, you benefit not only from the growth of your initial investment, but also from the growth of these new contributions. This creates a snowball effect. The combination of reinvested dividends and regular contributions builds momentum, causing your investment to grow faster over time. The result is a powerful cycle of growth, where each dividend payment and new contribution helps to generate even more growth, transforming your initial investment into a substantial financial snowball. Now, when considering your investment strategy, it's essential to think about your portfolio allocation by age. Here's a suggested allocation. Under 30, focus on growth stocks. At this age, you can afford to take more risks because you have plenty of time to recover from any market downturns. Investing in growth stocks allows you to maximize your returns over the long term. Ages 30 to 50, start mixing in some dividend stocks. As you get older, you might want to balance your portfolio with a mix of growth and dividend stocks. This strategy provides growth potential while also generating some income. Over 50, consider more stable investments. As you approach retirement, preserving your capital becomes more critical. Shifting towards more stable investments, including dividend-paying stocks, can provide a reliable income stream and reduce risk. Let's look at a more concrete example. Suppose you're 20 to 25 years old and have decided to focus on growth stocks, specifically dividend growth stocks. Matter of fact, let me show you a real-life example. Let's say you have a portfolio of these three stocks: REXR, Noble, and CTAS. Their investing metrics look something like this. Rexford Industrial Realty has a current dividend yield of 3.38%, a dividend growth rate of 13.49%, and an average share price appreciation of 13.39%. Noble, the ProShares S&P 500 Dividend Aristocrats ETF, has a current dividend yield of 2.13%, a dividend growth rate of 15.98%, and an average share price appreciation of 7.95%. While Cintas has a current dividend yield of 0.71%, a dividend growth rate of 21.5%, and an average share price appreciation of 27.07%. If you make a portfolio of these stocks, your portfolio dividend yield will stand at 2.07%, backed by a dividend growth rate of 16.99% and an annual share price appreciation of 16.14%. If you invest $10,000 in this portfolio and make a weekly contribution of $25, which comes to $1,200 annually, your future projections look very promising. After 1 year, the portfolio is projected to grow to $13,021. After 10 years, it'll be valued at $82,314. After 20 years, it will expand to $477,646. And after 30 years, by the time you're 60 or 65 when you retire, it's expected to reach a valuation of $2,678,751. These figures demonstrate the power of compounding, where the returns generated by the investment are reinvested to generate additional returns. This exponential growth is a fundamental principle of long-term investing. One of the significant benefits of investing in dividend-paying stocks is the potential for a steady stream of income. The dividend income after 30 years can be quite substantial, amounting to $59,641 annually or approximately $4,970 monthly. The total value added to the portfolio after 30 years includes both capital appreciation and dividend reinvestment. In this case, the total value added is $2,632,751, with $2,275,116 coming from capital appreciation and $357,635 from dividend reinvestment. The capital appreciation component reflects the increase in the stock prices, while dividend reinvestment highlights the additional shares purchased using the dividends received, further boosting the portfolio's value. Don't have a starting investment of $10,000 and can only invest $25 a week? Click the video on the screen to see how to convert it into a portfolio that pays around $40,000 in annual dividends.